Breaking news. Silver just pushed into the mid-90s, and the market is acting like $100 is a speed bump, not a ceiling. And here's the part that matters. While the paper chart is screaming overbought, real-world pricing is already treating silver like it's over $100 in parts of the world, and the official institutions are quietly repricing as if the old price never existed. That is what happened. I'm Jon AG, and this is the Currency Academy by Jon AG. Now listen closely, because the next few minutes are going to explain why this move feels fast, why it could get faster, and why the loudest people on the internet are missing the one signal that actually controls where this goes next. Silver didn't just rise, the structure changed. When a market climbs from nobody cares to everybody is staring, there is always a tipping point where the price stops being the story and the availability becomes the story. We may have just crossed that line. Silver is sitting around $95. Gold is also flying. But the real headline is the relationship between them, because the gold to silver ratio has dropped under 50, a level we have not seen in a long time. That ratio is not a meme, it's a pressure gauge. When it falls, it means silver is outperforming gold, and that usually happens in the phase where money stops treating silver like a sleepy metal and starts treating it like leverage. And leverage is what turns a normal rally into a panic move. Now, before you get hypnotized by the comics screen, I want you to look at the global reality. In Asia, physical silver has been trading at a premium versus the Western paper price. That means someone is paying more than spot to actually get metal. Think about what that tells you. A premium is not an opinion. A premium is a bid for something that is not easy to source. If the paper price says $95 and the physical market says $103, you're not looking at two prices. You're looking at one price and one warning. The warning is simple. The metal is being pulled, and that pull matters more than the headline number on your phone. So why is this happening now? Because multiple forces are hitting at the same time, and the market can handle one force. It can even handle two. But 3 or 4 forces stacking together, that's where the math starts to break. Force number 1 is fear. Geopolitical tension, trade disputes, tariff talk, and the constant sense that the world is sliding into a colder, more divided era. When that happens, money doesn't run to logic. It runs to safety. Gold is the first door people open. Silver is the second door they kick down when they realize gold already moved. Force number 2 is narrative. For years, mainstream coverage treated silver like the little brother of gold, a curiosity, a collector's item, something you talk about when there's nothing else to talk about. That narrative is cracking. When major media start saying out loud that silver has outperformed nearly everything, you get a new wave of attention that has no loyalty and no patience. These are not long-term stackers. These are momentum buyers. Momentum buyers don't ask permission. They chase candles. And when momentum buyers arrive in a market with tight physical supply, the result is not a healthy pullback. The result is air pockets. Force number 3 is the ratio trade. When the gold to silver ratio breaks key levels, big money starts rotating. Not because they love silver, but because the spread trade demands it. They sell gold, they buy silver, they compress the ratio further, and they create a feedback loop. If you're wondering how a metal can go from $60 to $95 and still feel like it's early, that is how. But here's the force people are not talking about enough, and it's the one that makes this move dangerous for shorts. Force number 4 is institutional repricing. The US Mint has been repricing silver products at levels that make the current spot look like yesterday's news. Now, I need to be precise here. I'm not talking about everyday bullion rounds. I'm talking about official products, collectibles, proofs, metals, items that used to be expensive but still anchored to reality. That anchor just snapped. We have seen examples where an ounce of silver in an official product went from around $90 per ounce to around $160 per ounce in a short window. Same ounce, same metal, same vault, different price. That is not retail greed. That is a signal. When an institution that has no reason to hype the internet quietly posts new pricing, it is telegraphing expectations. It is telling you, we're not confident this price will be available again. And that's why this matters. Because while the crowd is cheering the $95 print, the deeper story is that the trusted gatekeepers are already behaving like the next step is inevitable. Now I want to ask you something, and I want you to answer it in the comments. Do you think $100 is the top, or do you think $100 is the trigger? Because psychologically, $100 is not just a number, it's a headline. It's the level where people who never cared about silver suddenly feel stupid for ignoring it. That emotion is fuel, and when emotion hits a thin market, you don't get a gentle climb, you get a scramble. Now, let's talk about the elephant in the room, China. If physical pricing in Shanghai is consistently above Western spot, that creates a brutal incentive. Buy paper cheap in the West, source physical, deliver into the higher priced market. That's arbitrage. And arbitrage is the mechanism that punishes fake prices. You can manipulate a chart, but you cannot manipulate a global profit opportunity forever because someone will take the other side and drain the inventory. This is why I keep saying paper games have limits. At a certain point, a premium becomes a vacuum, and the vacuum sucks metal out of the system. And here's the part most people don't understand. When that happens, the spot price becomes a reference, not a reality. Reality becomes, can you actually get silver in size quickly without paying a painful premium? So what are the signs of stress? One sign is dealer restrictions. We've already seen major bullion dealers implement minimum order requirements, delays, and warnings about production backlogs. That is what happens when demand spikes faster than mints can stamp. And the moment you hear delays, you need to stop thinking like a trader and start thinking like a supply chain manager. Supply chains don't snap politely, they snap suddenly. Now here's the second question I want you to answer below. If you had to choose right now, would you rather own silver at $95 with availability or silver at $85 with no availability? Because that question tells you whether you understand what's coming. Most people are obsessed with price. The smart people are obsessed with access. Now, I'm going to take you one layer deeper, and this is where the plot thickens. There is growing talk about governments using price floors for critical minerals and processed materials, and silver is increasingly being spoken about in the same breath as critical. You don't have to agree with the politics to understand the mechanics. If a government decides a material is strategic, it stops acting like a normal commodity and starts acting like a resource. Resources get managed, allocated, prioritized. And when that happens, the free market gets quieter and the paperwork gets louder. A price floor is not a guarantee that the price goes up tomorrow. A price floor is a warning that officials are preparing for disruption. It's them saying, we cannot afford this to get too cheap because the industrial system depends on it. That is not a bullish tweet. That is a structural shift. And structural shifts are the kind that change a market for years. Now you might be thinking, okay, Jon, but we've seen hype before. Yes, we have, but here's what makes this different. This time, the rally is happening while inventories are already strained, while supply growth is slow, and while the world is racing to secure metals for energy, tech, and defense. That's the collision. And collisions don't end with the same old pattern. Here's the psychological warfare you need to expect next. If silver approaches $100 and hesitates, the headlines will say it's over. They will call it a blow-off top. They will tell you the smart money is exiting. They will show you one scary candle and try to convince you the entire thesis is dead. But the thesis is not a candle. The thesis is supply, demand, and policy. And those three don't change because a chart wobbles for a day. If anything, a wobble near $100 is the perfect setup for the next move because it shakes out the weak hands and reloads the spring. This is where the market tests conviction. And that's why your mindset matters. If you are staring at the price every 5 minutes, you are volunteering for emotional manipulation. Instead, watch the premiums, watch the delivery times, watch the official repricing, watch the ratio. Those are the real instruments. Now, quick pause, because this is the moment to lock in the community. And don't forget, subscribe to support the original work, and if you're part of the movement against copycats, comment Jon AG best so I can see you. All right, back to the numbers. Now let me show you the trick they use when a round number is in front of you. Round numbers are where emotion sits, and emotion is where stop orders sit. So $100 is not just a target, it's a battlefield. On the paper exchanges, the playbook is predictable. The moment silver flirts with $99, $80 or $99, $90, they dump contracts into thin liquidity, force a fast rejection, and then the headlines roll out the same line. Failed breakout. Momentum fades. But here's what they can't control. If physical premiums stay elevated, every paper smash becomes a gift to arbitrage desks and industrial buyers who can source metal cheaper in one place and move it to where it's bid higher. Paper can push a screen down for an hour. Physical pulls real ounces out for months. That's why the chart is loud, but the supply chain is louder. And this week, the supply chain is speaking. Watch the other ratio people ignore, the Bitcoin to silver ratio. As silver climbs, that ratio compresses, and the crypto crowd starts looking at metals again. Not because they suddenly love bars, but because they recognize momentum. When those buyers arrive, they don't tiptoe, they jump. And when they jump, dealers don't have time to refill, which is why you're seeing minimum order thresholds, shipping delays, and production backlogs. Demand can change in a day. Production takes weeks, mining takes years. That timing mismatch is how markets overshoot. Now, picture the next phase. Silver taps $100 in the overnight session. In thin hours, when moves are violent, the print flashes, screenshots fly, clips hit social media. Within minutes, you get market orders, not limit orders. Market orders are impatience. Impatience is how you gap a market. And once you gap a market, shorts have to cover into rising prices. which creates more buying, which creates more rising prices. That's how a quiet rally becomes a stampede. Now back to the US Mint repricing, because it's more important than people realize. When an official source re-rates its catalog, it's voting that replacement cost is rising and volatility is here. That's why you can see spot around $95, while official products imply far higher per ounce pricing. That spread is not just markup, that spread is stress. One last layer, supply response. Silver supply is messy because so much is mined as a byproduct. Even if silver screams higher, production doesn't surge instantly because the lever is tied to base metals and long project timelines. So the idea that higher price fixes everything is comforting, but it's not fast. And when supply can't respond fast, attention and momentum do the steering. Now add policy talk about critical minerals and price floors, and you get a market that starts moving in anticipation of allocation. Allocation is the enemy of cheap. It turns a commodity into a resource problem. And if silver becomes a resource problem, the public won't get the best price. Industry will. That's the real cliffhanger. The question isn't only, will silver hit $100? The question is, what changes after it does? So here's your checklist for the next 72 hours. Number 1, the premium. If spot rises, but premiums rise faster, that's tightening, not relief. Number 2, delivery time. If dealers keep extending ship dates even as price climbs, demand is not cooling. Number 3, the ratio. If gold is green and silver is greener, the ratio keeps compressing and the move stays dangerous. Number 4, official repricing. If more institutions quietly adjust catalogs upward, they're telling you the old price is not coming back easily. And number 5, the headline tone. The moment mainstream outlets go from silver rallied to silver is unstoppable, that's when late money floods in. That late money is usually the spark that turns $100 into $110, not because fundamentals changed overnight, but because psychology did. If you want one simple signal, it's this. When $100 arrives, watch whether it becomes a magnet that pulls price back or a door that opens and never closes. Silver at $95 does not feel cheap emotionally. But it can still be cheap structurally if the next regime is $120 to $150. And I'm not saying that as a prediction. I'm saying it as a math problem. If physical markets are already paying over $100, and if official products are pricing near $160 per ounce, then the market is telling you the spot price is behind the curve. Spot is catching up to the physical world. And when spot catches up, it usually does it in bursts. That's why the $100 question matters. Because once the headline prints silver hits $100, a new class of buyers arrives. The people who ignored $50, ignored $70, ignored $90, suddenly want in, not because they understand silver, but because they fear missing the move. That fear is not rational, but it is powerful. Now let's talk about the predictions you're seeing online. Some people are throwing out wild numbers, gaps, teleportation, $1,000 silver tomorrow. Ignore the noise. When a market gets hot, everyone wants to be the loudest person in the room. But the loudest person is rarely the most accurate person. The way you win is not by believing every extreme forecast. The way you win is by understanding the pathway. And the pathway right now is simple. First, silver hits $100. Then the ratio compresses further. Then premiums expand. Then policy language hardens. Then industry starts securing supply. Then the public realizes the shelves are not infinite. That is the sequence. And when that sequence runs, the price does not need hype. It needs momentum and scarcity. Now I want to make something brutally clear. If silver breaks $100 and holds, the conversation changes overnight. People stop asking, is silver going up? They start asking, where can I still buy it without getting destroyed on premiums? That shift is the moment the market flips from price discovery to availability panic. And availability panic is the phase where the average person loses, not because they were wrong, but because they were late. So what do you do with this information? You keep your head. You avoid emotional chasing. You focus on strategy. If you are buying physical, you prioritize ounces and recognizability over fancy stories. If you are trading, you respect volatility and you don't get reckless. If you're watching from the sidelines, you stop waiting for the perfect dip that never arrives, because the perfect dip is the one that exists before the headlines. And right now, the headlines are waking up. That is why this moment matters. Silver may never be this cheap again, not because $95 is a bargain, but because the old world where silver was ignored is ending. We are moving into a world where silver is watched, chased, and politically classified. And in that world, the price behavior changes. Here's the cliffhanger you need to hold in your mind. If the global system decides silver is strategic, then the next shortage will not look like a normal shortage. It will look like allocation. It will look like restrictions. It will look like priority buyers getting first access, and the public getting what's left. So as we step into the rest of this week, keep your eyes on one level, and it's not just $100. It's the behavior around $100. Does the market slam it and get rejected, or does it chew through it like it's nothing? Because the way silver behaves at $100 will tell you whether we are in a simple rally or the opening act of something bigger. Stay sharp, stay calm, stay strategic. Take care of yourselves, take care of each other, and I will see you in the next video soon.